Wells Fargo, which is the second biggest U.S. home lender, has stopped issuing so-called Alt-A loans made to people with near-prime credit ratings or to borrowers with the best credit who don't document their incomes. First Horizon of Memphis, Tennessee, said it has raised rates significantly on such loans in the past 2 weeks. It's cutting back on the number of loans it's making. We're also seeing that Wachovia now raising rates, imposing stricter standards on some of their most credit-worthy borrowers as well. So, will a growing credit crunch spread? Will it be another blow to an already weak U.S. housing market? Here now, John Sauro. He's president of North Atlantic Mortgage Corp. John, welcome back to the show.
Thanks, Kathleen. Good to be back.
So, let's start by looking at what we're seeing from Wells Fargo, Wachovia, First Horizon. Are they crunching credit? Is this something we should be worried about really spreading over to housing, making it worse?
Kathleen, it's a temporary problem. What's happening is that they don't want to have a credit crunch and they don't want to raise rates. What's happening is the secondary market around the world is concerned about the problems in the subprime and in the mortgage arena. And so what these markets have done is they've raised their fees and their rates to buy these loans from companies like Wells Fargo and all the other lenders that are out there so that they can protect themselves and hedge themselves going forward. Certainly they're going to have some losses from what has happened, but they want to be careful also going forward that they don't incur any more losses.
So they're saying this is a temporary thing, you're saying? It's not as though they're saying that's it forever? And is it because they now don't feel that the credit markets will give them the liquidity they need to go ahead and make loans? Is it because they're afraid the market is repricing and they're so uncertain about what the price of a mortgage should be that on some level they're pulling back and saying, we don't want to give anybody a price right now. We want to see how this settles down?
Well, what's happening is the secondary markets basically are telling the lenders that, look, we don't want to buy certain types of loans. We found those loans to be more risky due to what's been happening in the marketplace. We want to protect ourselves, and these are not the types of loans we want to buy right now. That's not going to be forever. It's going to change. Nothing is forever, and it's a matter of them working this out, and when the credit markets ease up a little bit, some of these loans will be back in the arena again.
Do you worry that this could be something on the order, say, back around 1994? You know, we had come out of recession, but that was the bad year for the bond market when prices plunged and yields went up, and it really did cause some reverberations, negative reverberations in the mortgage market.
I think we have to be concerned about that a little bit, but, you know, look at what Secretary Paulson says. He says this is contained. We do still have a strong economy. Jobs are still strong, even with the recent weakness in the report. Consumer spending is still strong. Overall, the economy is good. And guess what? Interest rates are still, you know, historically low, even by today's standards. One of the things I want to say is that there's just much too much wild and irresponsible speculation about these markets. The attention these markets are getting right now is only helping to spook the secondary markets even more. And add to that the negative doomsday authors that are looking to sell books by promoting fear to the American people, and we've got a self-fulfilling prophecy.
Well, you're a mortgage lender. Tell us what you are doing. Have you pulled back? Are you raising rates? Are you saying, hey, don't worry to your customers, I'll give you a mortgage. If the mortgage pushes the rates up, it's going to cost a little bit more, but I've got the liquidity, I'm here, and I'm not changing the way I do business? Or have you changed the way you do business, at least temporarily?
Temporarily, we did have to change the way we do business because we're also at the mercy of the investors as well. We sell our loans to the different lenders and investors that are out there, and we're at the mercy of what they're willing to, what they want to charge for these loans. However, we always look for alternatives, and I'm advising our clients that if they were contemplating on doing anything, that they should do it now and not wait, because there may only be other adverse changes going forward for a while. So if you really need to do it now and get it done.
But that's sort of a defensive thing. You're not predicting that. You're just saying, because of the environment, this sense we have. Okay. John Sauro, thanks for joining us.
You're welcome,
Appreciate it
Kathleen.
as always.